bulls roaring back on Wall Street thanks to strong bank results and core inflation growth slowing last month. And on the flip side, the yield on the 10-year sliding roughly 14 basis points on the day. For more on the latest market action, let's welcome in now Ed Yardeni, Yardeni Research President. Ed, always good to see you. So you wear two hats, Ed, economist and strategist. So let's start with your role as the former. As an economist, I am curious to get your take on that CPI report we got today. Ed, what did you make of it? What do you think the Fed makes of it?
Well, it was very good news. The top line in yesterday's PPI and today's CPI were better than expected. But still, there's still some sticky areas of both inflation rates in the services area. So I think it still keeps the Fed on pause. I don't know that they've officially announced pause, but I think the markets have figured out that the Fed probably won't be lowering interest rates anytime soon. And meanwhile, the bond market loved that inflation number because I guess there's a lot of fear that it would be a hot number. We thought it might be on the hot side. And so there must have been a lot of short covering in the bond market, maybe some players thinking we're going to go to 5%. And we didn't do that. We're very comfortable with the bond yield being around 4.5%, sort of on a trend long-term basis. So we have no problems with what's going on in the bond market. And then, of course, as you folks just mentioned, that's turned out to be very good news for the stock market overall.
But how sustainable is this, Ed, I guess? Because we had been seeing yields creep up and up and up.
Yeah.
Today was just one report. Is that inflation demon vanquished?
No, I don't think it's vanquished, not if the target is 2%. And the Fed has made it very clear that for the sake of their credibility, they intend to get inflation down to 2%. I just think they got a little bit too confident that if they lowered rates, that inflation will continue to decline towards their 2%. And there's some areas where that's just not the case. We're not at 2% on the inflation rate, and we're not there on a sustainable basis. So there could still be some issues here. We know that energy prices pushed up the December number, and they'll do the same for January. We know that food prices can be volatile. So no, we're not out of the woods when it comes to getting inflation down to 2%, but we're awfully close. So I don't know that the markets basically says, well, it's close enough. And meanwhile, the economy is looking good. Earnings are great. The financials are doing extremely well. So it's kind of a roaring 2020 sort of day today.
When do we get back to that 2%, Ed? I'm just curious, as you try to model out a possible timeline, what does it look like?
Yeah. Well, we're big believers that productivity growth is making a big comeback here. We think we're in a productivity growth boom as a result of all the technological innovations that can help augment the productivity of workers. And so if we don't do it later this year, I think we'll see 2% inflation next year.
Ed, going back to yields for a second, I did want to bring up a term that we have noticed popping up a lot in interviews when talking about fixed income, and that is the return of the bond vigilante. Yeah. It's a term that you coined back in the 80s. The definition, for those who don't know, is investors who sell government bonds in response to fiscal policies that they view as inflationary, which would then drive up borrowing costs for the government. So there's a lot of talk about this incoming administration, about its fiscal policy being potentially spendy, and what that's going to mean, if that's going to augur the return of the bond vigilantes. What do you think?
Well, I think it's still a relevant risk. I mean, it certainly looked like a more relevant risk a couple of days ago. But markets will be volatile on a short-term basis. I think there's still a lot of concern in the bond market about undisciplined fiscal and monetary policy. I think the fact that the Fed lowered rates by 100 basis points and the bond yield went up 100 basis points was a clear indication that the bond vigilantes, so-called, just didn't agree with what the Fed was doing. And the interpretation I got was that the bond market was basically saying that the Fed was stimulating an economy that didn't need to be stimulated. So that's kind of where the bond vigilantes are. But at some point, the yield becomes very attractive here, and you get to 4 3/4. Anything close to 5% is something that people want to lock in. And just the fact that many people were waiting for 5% frustrated them because they're apparently not going to get it today, certainly. But yeah, it's still a problem. And I think the jury's out. The bond market, the bond vigilantes want to see how the Trump administration is going to put together all the pieces of their proposal in a way that gets us some relief on the deficit outlook.
And I think the last time we spoke to you, I was asking you, what sectors you wanted to be overweight. I think, Ed, it was technology,
Yeah.
financials, industrials. Would you still want to be overweight those sectors here?
Yeah, absolutely. They're not cheap. They've already been in a great bull market, but their earnings outlook remains very strong. And so I think from here on, the bull market continues on earnings and less on valuation. And again, I think we got a glimpse of that today when better than expected earnings from the financials drove their stock prices higher. That's what I'm expecting.
And when we look ahead to earnings season here, which of course we're just starting to get into, what are you sort of most focused on? What do you think is going to be most important for investors to watch for?
Well, I actually thought today and tomorrow the financials would be most important because to really get a sustainably strong bull market, it's very, very helpful to have a strong financial sector, and that's what we have for sure. I think we need to increasingly convince investors that even though valuations are high in the tech area, this is not going to be a repeat of the late 1990s and early 2000s, the tech bubble followed by the tech wreck. I don't think that's what we're looking at. I think we're looking at earnings continuing to march higher for tech, communication services, industrials, because I think the U.S. economy is on course for a productivity boom based on the technologies that are available to accomplish that.
Ed, great to see you as always. Thanks so much.
It was a pleasure.
Thank you.
Thank you.